Hi, today I'm going to talk about financial markets and institutions. In the first slide, we will see the capital allocation process. There are three types or three ways the capital is allocated. First one is direct transfers of money and securities. In this process, the business issues securities in form of stocks or bonds to the savers, and the savers in return pay money or dollars to the business. So this is a direct flow of fund between business and savers. The second method of the capital allocation process is indirect transfers through investment bankers. In this process, there is an intermediary that is called investment banks play a middle role. Here, business sell their securities to investment banks and the investment bank distribute these securities to the savers. In return, the savers pay money to the investment bank and after taking some charges, investment bank pass on that money to the business. The third method of the capital allocation process is indirect transfers through a financial intermediaries. Under this process, business issue business securities to the financial intermediaries, and the financial intermediaries issue their own securities to the savers. In return, saver pay dollar or money to the financial intermediaries, and the financial intermediaries pay the amount after keeping their profit to the business. Here, the financial intermediaries take a risk of holding the business securities for a particular short period of time. Now, let's move on to see how the financial system works. Here, the suppliers of the fund, that are individual businesses and governments, actually supply fund to the financial intermediaries. And in return, financial intermediaries provide an investment opportunity through issuing securities, providing securities or deposits for the suppliers of the fund. Now, these financial intermediaries provide the fund in terms of loan to the demanders of the fund, like businesses, governments, or individuals as well. In return, the demanders of the fund supply security to the financial market and then get funds from the financial markets. In return, financial markets get funds from the suppliers of the fund by issuing securities to them in form of equity or debt or bonds. Now let's move on to the next slide to see the types of financial markets. There are various types of financial markets. Let's see the first one, the physical asset market and the financial asset market. Physical asset markets, that is also called tangible or real asset markets, are the market for products like machines, equipments, real estate, buildings, etc. Whereas financial asset markets is the market that deals with stocks, bonds, notes, debentures, etc. The other form of market is spot market and futures market. Spot markets are the markets in which assets are bought or sold for on the spot delivery. This means that the delivery takes place within a few days, whereas future markets are the markets in which participants agree today to buy or sell an asset at some future date. The other financial markets are money markets and capital markets. Money markets are the markets for the short period of time, and these money markets, are for highly liquid debt securities. Whereas capital markets are the markets for long term securities like equities and long term bonds. The other form of market is primary market and the secondary market. Primary market are the markets in which corporations raise new capital, where secondary market are the markets in which existing and already outstanding securities are traded among the investors. Now let's move to the next form of the market, and that is private market and public market. Private markets are the markets where transactions are negotiated directly between two or more parties, and that they are differentiated from the public market, where the market is where the standardized contracts are traded on organized exchanges. So in the public market, the standardized contracts are traded on organized exchanges. Now let's see the types of financial institutions. First one is investment banks. These are the organizations that underwrites and distribute new investment securities and help businesses to obtain financing. The examples of investment banks are Morgan Stanley and Goldman Sachs. Commercial banks. These are the traditional department store of financing, serving a variety of savers and borrowers. For example, Bank of America, Citibank, Wells Fargo, and JP Morgan Chase. The other form of financial institutions are financial serving corporations. These are the firms that offer a wide range of financial services, including investment banking, brokerage operations, insurance, and commercial banking altogether. Credit unions. Credit unions are the cooperative associations whose members are supposed to have a common bond, for example, such as being employee of the same firm or being of same locality. The other form of financial institution is pension funds. Pension funds are retirement plans funded by corporations or government agencies for their workers, and it is administered primarily by the trust departments of commercial banks or by life insurance companies. So these pension funds are actually regulated by the commercial banks or insurance companies. Other form of financial institutions are life insurance companies. The life insurance companies take savings in the form of annual premium, invest these funds in stock, bond, or real estate or market, and make payment to the beneficiaries of the insured parties. Mutual funds, on the other hand, is an organization that pool investor funds to purchase financial instruments and thus reduce risk through diversification. Other form of financial institution is money market funds. These are mutual funds that invest in short-term, low-risk securities and allow investors to write checks against their account. Exchange traded funds, ETFs. ETFs buy a portfolio of stock of a certain type, for example, the S&P 500 or media companies or Chinese companies. and then sell their own shares to the public. ETF shares are generally traded in the public market, so an investor who wants to invest in the Chinese market, for example, can buy shares in the ETFs that hold stock of the particular market. Hedge funds. Hedge funds are also similar to the mutual funds because they accept money from the savers and use the funds to buy various securities. But the problem is that hedge funds are unregulated. Next one is private equity companies. Private equity companies. Private equity companies are organizations that operate much like hedge funds, but rather than purchasing some of the stocks of a firm, but rather than purchasing some of the stocks of a firm, private equity players buy and then manage the entire firm. They don't buy or purchase a particular amount of share, but actually they buy the whole business and manage them. The next is the stock markets. Let's see the types of stock market. Physical location exchanges. These are formal organizations having tangible physical location that conduct auction markets in designated securities. NYSE and several regional stock exchanges are the example of physical location exchanges. The next type of financial market is over-the-counter market. This is a large collection of brokers and dealers connected electronically by telephones and computers that provides for trading in unlisted securities. Nowadays, a new market has emerged and that is called dealer market. A dealer market includes all facilities that are needed to conduct security transactions, but the transactions are not made on the physical location exchanges. Now let's move on to some points that you need to remember. Closely held corporation. A corporation that is owned by a few individuals who are typically associated with the firm's management. So here the management owns the corporations. Publicly owned corporations. A corporation that is owned by a relatively large number of individuals who are not actively involved in the firm management. What is going public? Going public is an act of selling stocks to the public at large by a closely held corporation or its principal stockholders. The next point is IPOs, initial public offerings market. This is the market for stocks and companies that are in process of going public. So this was all for today. Thank you very much. And yes, if you like my videos, please like and subscribe it. Thank you.